Good afternoon, ladies and gentlemen, and welcome to the introduction to Elle Holdings PLC and the review of the interim results to 31st of October and prospects. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screens, or if anyone has dialed in via vanell@walbrookpr.com. The company may not be in a position to answer all the questions today. However, the company will review all questions submitted and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. We anticipate that there will be some newcomers to Elle attending today, so we will take a moment to introduce the business. I would now like to hand you over to Chief Executive Mark Cutler and Chief Financial Officer Graham Campbell.
Thank you, Tom. Good afternoon from me. I'm Mark.
Good afternoon, everyone. I'm Graham.
We'll run you through the overview of the company fairly quickly, just to give you some background, and then we'll go through in more detail the key points around our interim results and the outlook and strategy for the business. Just to let you know, I've been Chief Executive now since autumn 2018. And we've been through quite a transition program, so very much looking forward to telling you a bit more about it. First thing I probably need to explain is regarding what happened last week. So apologies that we had to cancel the session last Thursday. As you may have seen, some of you may not, we had a serious incident during the course of Thursday on one of our sites. It did result, unfortunately, in a fatality to a subcontractor in and around some of the operations that we were involved in. So extremely serious incident. Obviously, it's under investigation by several third parties and ourselves. We're all devastated with what's happened, and it involved an operation that very much a one-off equipment failure that we've never seen before. So I just wanted to explain that up front, and hopefully that explains why we had to cancel last week. I'm sure you understand the importance that we attach to health and safety in the business. Perhaps linked to that, I just want to give you an idea of what we're all about. We're the UK's largest geotechnical contractor, which means we do piling primarily, and many different types of geotechnical work and foundation work, from the early beginnings of site investigations through to the biggest types of piling in the UK. We've been listed on AIM since late 2016, and we've been the largest in the UK for the last 2 or 3 years. We work only in the UK at the moment. Our biggest competitors are actually several big European players who are active on some of the bigger infrastructure schemes in the UK, whereas we work right across the board in a very diverse set of sectors and a very broad set of capabilities. So our vision of total foundation solutions is true. This has been born out of the early beginnings of the company. It still stands today in terms of we are very much a one-stop shop in terms of geotechnical engineering, and we therefore have tremendous technical and engineering depth. We deliver 25 different types of foundation and piling engineering, and a very strong brand across the UK. And our values, which support our work, begin with safety, and that has been the case ever since we've been in business. Really important to us, the way we operate and the culture within the business. I've been busy building a team to modernise the business, create a more collaborative culture and a more professional approach to our customers as we seek to grow into the next phase of our strategy, which we'll tell you about on the following slides. So there's a quick reminder of the 3 main sectors that we work in. Reasonable balance across the 3. The residential market is house building and larger residential projects. Infrastructure is very broad approach to highways and railways in particular, but also we do a lot in the energy and flooding sectors and other activities around utilities. So a wide range of infrastructure work. And regional construction entails buildings in city centres and also out of town industrial and mixed-use developments. A quick overview on one page of what our strategy looks like. So down the left-hand side are the three sectors that I've just mentioned. Our exposure across those three is reasonably well balanced. Historically, we've done a bit more in residential, but as the last year or so has evolved, very much in line with our strategy, we're expecting infrastructure to probably be the dominant area of where we are targeting our future business. So I'd expect infrastructure to continue to balance upwards slightly. We have a blue chip customer base, which in my experience of 32 years in civil engineering and construction markets for tier one contractors, is as an attractive customer base as I've ever seen. Very, very strong, broad customer landscape. Our task is to make sure that we've got the depth of relationships that we need to support our strategy going forward, because our markets are backed by very positive long-term dynamics that we've listed here, and all of you will be aware that we're expecting increased investment in housing, certainly in infrastructure, and post-Brexit and post-COVID, we do anticipate the wider building market to improve that we haven't had the benefit of in the last 2 years. And our business units, and there are 5 of them, cover these segments very, very well and interface with each other to cover off the 25 capabilities that I mentioned earlier in quite a seamless way. We've set out medium-term financial targets on the right-hand side of this slide. We first put these in the public domain in the market placing that we undertook in April, where we moved early to protect ourselves against the potential worst downsides of COVID. But back then we were committed to these mid-term objectives, and these are very much now part of our strategic plan. We've undertaken a full strategic review, satisfied ourselves that we're in the right markets with the right skills, and these blended targets are achievable across our divisional mixes in the markets I've mentioned. So in summary, we are very much an organisation that is capable of growth and premium performance because of our diverse capability. That's helped us be resilient through the last few years of very difficult trading. I mean, the construction market has been pretty challenging for the whole time I've been here. But whilst one division or one segment is a little bit subdued, usually we find that we have a compensatory uplift in other areas. And what we're expecting as the markets improve further is that more of those business units and areas are going into a growth mode as we look to improve our margins as well in our premium niche areas. And so that market leading capability is already there. What we need to do now is take more advantage of the very strong asset base that we've got and the 500 or so direct employees who are long-term, loyal team that we've managed to retain through the COVID pandemic. And then finally, in terms of just explaining what the business does, this slide gives you a 9-box summary of the different things. So lots of orange rigs, 120 rigs approximately across the business, operating in all sorts of different environments. Some of these very specialist, and some of the rail activity in particular quite unique. So as a whole, these capabilities work together in a blended, as I say, one-stop shop that is unrivaled in the UK. So introductions completed. I will now just go on and give you a quick overview of what the period that we're reporting meant to us and how we did, and then we'll go on to talk about the financials in a little bit more detail. So in overview, it's been a really, really tough 6 months. So we're reporting here our interims to the end of October. You'll all be aware that COVID hit at the end of March 2020, with 6 weeks of our previous financial year to go, wiped out 80% of our revenues in April. In the same month, we moved very quickly to secure the capital placing that I mentioned earlier, and that gave us significant balance sheet strength going into what we might be facing in the year ahead. What we saw was a steady recovery during Q1 and into Q2 that was slightly ahead of our expectations, and we returned to normal levels of activity in September and October and returned to profit during those 2 months. But not surprisingly, in the round, we were behind the activity levels of last year, just over 20% behind. What I can say, and we're delighted with this, is that we've managed to hold our margins through these difficult months. So despite revenues being down, gross margins, which is a contribution from our projects going in towards central overheads and profitability, held up. So operational performance, despite being disrupted by COVID, working practices, and all of the other challenges that our workforce were dealing with, we kept working all the way through. Our lads and ladies were coming into the office, which has been open throughout, working away from home all week to deliver projects for customers without complaint and generally without interruption. We've had our fair share of people with COVID and self-isolating like everybody. We've managed to move resources around, and despite this, our margins have stayed consistent with last year. And that's because we've managed to improve operational performance as we'd hoped in certain parts of our business, particularly general piling. And we've enjoyed strong margins in specialist piling. But that's been mitigated downwards by a relatively negative work mix, in that we still see less rail work coming through than we expect in future years. So despite lower rail work, I think we've done quite well with operational performance. That's led to a nominal loss at half year, slightly ahead of I think what most people expected and our own expectations. A strong cash position, because as Graham will go on and say, we've done a great job of hanging on to our cash. We're still paying our suppliers, but our cash management has been much improved, supported by the balance sheet strengthening and further enhanced by future liquidity provided by a new asset-based lending facility that gives us quite a strong resilience going forward, and that's been secured in October. So we finished the year with net funds. We've been in a net debt position for many years, actually. Our debt levels are coming down, primarily around higher purchase of rigs, and we're in a net funds position, which is great. And we'll go on and talk a little bit more about that shortly. I think I've covered probably the worst aspects of COVID, being very much a period of survival. Like all businesses, we're no different. We've had to fight for every project to get started and really manage. A lot of people furloughed. 50% of our workforce were furloughed at peak. A lot of anxiety amongst that group in terms of whether their jobs will still be there or not. In the end, we made less than 20 redundancies in total, which is unfortunate, but actually it's allowed us to be a bit more efficient in certain areas. And this is common, I think, in a lot of businesses, that you find that you can find ways of being more efficient with less people sometimes, and we've seen a bit of that. So we've done some trimming, but we've also been recruiting, because we're confident about the future. We've been recruiting estimators, commercial staff, and 1 or 2 senior team members ready for FY22 in particular. And this next slide, slide 12, really at a glance shows you the sort of roller coaster that we've had over the last 12 months or so. Wouldn't really want to have a revenue profile looking like that very often. there are built-in cyclical pressures in our business anyway, because every winter the weather, obviously conspires against us to some degree, and we have a 2-week Christmas close down in the construction sector that always leads to a weaker December, and before that a November, and after that January that are weaker than normal, and then we rebound again into the spring and through the autumn. And of course, we lost all of that usual opportunity in the period we were just talking about. Going forward, I expect, as I'll say in a minute, to see a much more normal profile during the course of the balance of FY21 and into FY22. I'll just point out on that last bullet point that inquiry levels, despite everything, inquiry levels have held up quite well. I mean, we weren't really getting any inquiries in the first 2 or 3 months of the year. Everybody was shut down. Everyone was working from home for the first time. Procurement officials were, adjusting to new processes. So the fact that we're still doing roughly on an annual basis 5,000 bids is pretty much in line with normal levels, slightly behind, but bodes well for the future. So we think the demand is there, and as we'll go on to say, we think the demand is going to increase given investment in major infrastructure and housing markets that very much in the public domain that I'll touch on later on.
Okay, thanks, Mark. So I'll just take us through the next few slides, just reflecting on the divisional performance across the first half. You'll see from slide 14, the income statement really displays the revenue decline that we saw year on year, with all of that really caused by the shortfall in revenues in Q1, May, June and July, as a result of COVID. And as Mark mentioned, fairly pleasing to see the margins holding up. We had concerns, of course, around new site operating procedures that would be put in place and have been put in place to support the challenges that every business in construction is facing around the COVID. That's new measures around social distancing and hygiene measures, etc. And pleasing to see that the margin has held up broadly consistent with last year. I think importantly, we've worked very hard across the business in our divisions where we felt we could improve margins, and so the story is that we've seen some improvement around specialist piling, as Mark mentioned, the housing division, and unfortunately that's been offset by a rather subdued period in rail, although looking forward we have a degree of optimism in that area as well. The order book closed the period at the beginning of January, the latest position 23.6, and our year-end order book was 21.4 million. So broadly happy that that's remained stable, a slight growth on the year-end position, and particularly given the challenges that we faced over the last 9 months since the onset of COVID, we're broadly happy with where that is. That gives us reasonably good visibility of 2 to 3 months out, and then we'll have some longer-term contracts in place which will impact FY22. So to Mark's original comment around the underlying operating loss, a relatively modest loss in the period despite the COVID challenges of 400,000. Next 3 slides cover off the different divisions. General piling is our unrestricted access, large piling division, the largest of our divisions, and you'll see that the revenues declined period on period, and again all of that is down to the shortfall in Q1 with the lower activity levels. We mitigated some of that activity, some of that lower activity by cutting back on costs, and that's some part-time working in the office. We've obviously taken advantage of the government job retention scheme. Some of the senior leadership teams took temporary pay decreases, and we've had general cost mitigation measures and be very prudent in our spend in the period. So what that's led us to do is to deliver a broadly similar underlying operating profit year on year despite the shortfall in revenues. The next division, we grouped together specialist piling and rail. Specialist piling is the more challenging, typically restricted access piling work, and rail is the on-rail activity. What we're seeing here is a combination of specialist piling operating near capacity, really for the majority of the first half of the year, so really positive performance, and we're very pleased with how specialist piling has performed and continues to do so. The rail division largely as a result of the impact of Network Rail's CP6 delays. And in particular, what we've seen is some of the work where we typically would benefit as a business, typically electrification programs, they are spending money, but unfortunately the money that's being spent is not specifically in the areas yet that has benefited Van Elle. Although we do expect, and we're starting to see some of those tenders coming through. So we're still optimistic in that area. And on the back of that, we've made a recruitment to lead our rail division, and David Buckley joined the business early January, and that's really a reflection on our confidence in the future. Although we're unlikely to see significant impact in FY21, we think that the works will start to come through in FY22. And ground engineering services, the final grouping of our housing division. So you'll see the picture on the right hand side of the slide is a SmartFoot installation. So housing really is the modular SmartFoot solution, foundations for houses, coupled with Strata, which is our ground investigation business. Of course, the house was fairly well known that the house builders activity closed almost overnight at the end of March 2020. And stayed closed for a reasonable period of time. We started to see house building activity pick up again, but not really before June. And we've seen a gradual and steady recovery since then. And the housing division is operating near capacity today. So certainly the market has recovered ahead of our expectations, but not without a significant hit in Q1 to our revenues. And you can see that significant decline from 16.9 down to 11.7 year on year. Strata as a business has been largely unimpacted. It's typically the first of our divisions that's out on site, largely unimpacted by COVID, but unfortunately forms only 4.5 million of our group revenues annualized. And so despite the fact that that's progressed well, we don't see the significant change in the full year group numbers. I'll just touch briefly on the balance sheet and net funds. I think Mark's covered off the key points already. During the year, we obviously had the capital raise back in April 2020. That raised 6.7 million gross funds and added to the cash balance. And that's one of the reasons we're into a net funds position at the end of the half year. In October 2020, we also established a asset-based lend facility, which is effectively an RCF facility of up to 11 million. It of course requires us to maintain a good quality debtor and asset book, but it provides I think a substantial amount of headroom for the works that we expect to come in 2022 and beyond, FY22 and beyond, and it gives us that headroom and liquidity headroom to take advantage of those opportunities as they arise. And so what you can see there is a cash finishing the half year at 9.8 million. Couple that with the 11 million headroom, are broadly comfortable with where the balance sheet currently stands. We've done some work in the period to work through our aged debtors, and that's led to boosting the cash position as well. We had some challenges 12 months ago, and we worked through the majority of those and broadly happy with the working capital position. You'll note that working capital has increased since the end of the year, and that's really just a reversal of the sharp decline that we saw in working capital in April 2020 as our revenue activity dropped off. And final point is that we are now approaching very low debt as a business. The only remaining debt we have is hire purchase, which is how we've previously purchased all of our rigs, vans, and transport equipment. And that's gradually being paid down. So at the end of the half year, we were down to 5.3 million capital outstanding. As I say, the only debt that the group has. By the end of the year, that will be down to 3.5 million, assuming we take out no further hire purchase. And as that unwinds further in FY22, we'll be down to a very small amount by the end of the next year. And finally, the cash flow slide. I think we've covered off the main points here. Talked about the working capital movement. The only real point to highlight here is that we've kept capital tightly under control during the first half. Mainly for cash preservation, making sure we got through COVID and came out the other side stronger. We have some capital committed in the second half, broadly 1.5 to 2 million, and the timing of that will be either in the second half of FY21 or early FY22, depending on the timing of rig deliveries. So again, broadly happy with where the cash position has ended up with nearly 10 million in the bank at the end of the period.
Okay. Right. So I meant that comment on the previous slide. Actually, it's a good summary of how I feel. Our strategy is unchanged. We first launched our revised strategy in early 2019 after I joined and had a chance to look at things, and it's been consistently reported and delivered against since then. Certainly, it's had a few challenges along the way, but in summary, we are embarking on a consistent strategy with a very clear focus on where we're going, and we still see, and hopefully you'd agree, considerable opportunity in the markets that we're well positioned in, and building a team to take full advantage of those opportunities has been quite important to the work we've been doing. And the next slide very much just summarises that strategy at a glance. I don't propose to go through every line, but happy to take any questions. The first phase has been all about stabilising the business, rebuilding a bit of confidence, and restructuring the team, addressing operational weaknesses, addressing future capacity weaknesses. And there's been quite a lot to do, quite frankly. Being assisted by a team that is 80% new and 20% of tremendous talent that was already here. And in so doing, we've brought everyone together in one single co-located premises. Previously, we were siloed across multiple offices, quite old-fashioned setup. We're now a much more collaborative, progressive business with a bit of buzz about the place. And so phase one is substantially complete, although only recently have we still put in place some of the further strengthening around commercial roles, but that's because we're coming through COVID and we see the importance to get some of these key personnel on board now. Phase two, we started at the same time, but takes longer. It's putting in place the longer term growth foundations for the business. And by that, I mean maturing our business development and marketing and bidding capabilities and our customer relationships and partnerships across the country, right? So it's a never-ending task, actually, and one that we're all enjoying doing because we're seeing the results of increased awareness of what Van Elle can do and closer relationships with customers who ultimately we expect will work more closely with us at an earlier stage of project development. And the evidence of this will be more repeat business and improving margins and growth. And then phase three is pretty much talking about the single strategy on a page slide that we showed earlier, where the definition of market leadership is the points I've made here, plus the midterm financial objectives that we outlined earlier. So to wrap up, after all of that, and I hope that's not too much of a gallop through things, we are continuing to trade slightly ahead of what we expect. We've had Christmas and the worst of the winter, I hope, is now behind us. And we go into February, March, April, traditionally quite sort of buoyant months for us, with decent momentum in terms of our order book and customer needs across the board. So housing and specialist piling are still working at capacity. General piling has got a series of key projects that will be starting in the next month. The rail guys are starting to see opportunities coming through. We've got a busy quarter ahead in terms of some of the important tenders that are going to set us strong for FY22, and we might see the start of some of that before our financial year finishes, but I don't want to make any promises. But we do believe we see now the workload starting to manifest itself, ready for FY22. And assuming that we don't have further disruption, and we shouldn't, from COVID, that is any different than what we've been coping with over the last 6 months or so, we should get through Q4 with strong momentum, a reasonable momentum going into FY22. And we've got a strong financial position in terms of the capability and resources going forward to take full advantage of the opportunities that are starting to come through. So all in all, we feel we've come through things quite strongly. We feel well placed for the opportunities ahead, and we've given a slight tickle upwards to the expected result for FY21, which is never going to be a year to judge us by, but nonetheless, we do expect to finish slightly ahead of the single number that's out in the market at the minute, and we'll come on to that perhaps in a second in terms of how we reinstate guidance. Yes, worth mentioning this final slide, which is appears at the end, and again, happy to take questions. So we're keen to make sure that we're transparent in terms of some statistics in the business. Now, H1 of 2021 is not a glorious set of KPIs to reflect on, but there are a few points in here that are worth noting in line with what we've said. Certainly, you can see the reduction in capex. You can see the margins holding up. Actually, 2 lines above that, gross margins. You can see the rig fleet being fairly stable, but we've made disposals as well as we've ordered some rigs for the next financial year. Poor utilisation, as you'd expect, given the circumstances we've described, but that will improve. And a note at the bottom: we're going to change the way we measure utilisation to be more reflective of the asset values, rather than just a flat measure across our entire fleet, because there's a whole mixture of big and small and older new rigs, as you would expect. Still delivering the best part of 1,000 projects a year, so extremely busy business, bidding 4,000 to 5,000 bids a year. We have to bid for everything we do. We don't have a parent company that gives us any work, unlike some of our competitors. So we are extremely competitive and innovative in the way that we operate in order to win as much work as we do. We are going through a little bit of a safety challenge, not least because of what I described at the start of this presentation, but we also know we've got work to do here. So that's one of our improvement plans, is to see some of those stats heading the right way. I will point out the near miss reports are a positive thing. Okay, these are hazard identifications, they're proactive interventions before accidents take place. So it's good to see those trending upwards, and that's part of our engagement process with our workforce. And then just to finish off, you can see that we've got more than 5% of our workforce under training or apprenticeships, which is something we intend to absolutely maintain.
Great. Okay. Well, thank you, Mark. Thank you, Graham. If we could turn to the questions, we've had a number of questions that were submitted ahead of the presentation. However, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. I'd like to remind you that there is a recording of this presentation along with a copy of the slides that will be published on the Investor Meet Company platform, along with the published Q&A, which will appear after the event. Additionally, your feedback is important to the company, so immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback. If you could, that would be much appreciated. While you're submitting questions, if we could just have a look at a couple of those that were pre-submitted, and we've got a number that are that focus on the rail division and the rail division's activities. And it might be a good opportunity, Mark, maybe if you could even just add a little to that, just in terms of the dynamics of rail and the breadth of the activities within the division. And if you could add into that, Simon's asked who the main competitors are in the rail division, and what makes Van Elle the compelling choice. And also Stephen's asked what it is that gives you the confidence that your rail business is set for this recovery. Maybe we could start with that slightly rounded question.
Yeah, right. So look, this is the most popular question we get asked. Tell us a bit more about your rail business and what does it do, and why is it different? We've just flicked back to the cover sheet, because there is one of our rail rigs. So by the rail business, we mean specifically the on-track geotechnical and piling fleet, right? We do an awful lot in the rail sector generally away from the track. We've started, by the way, our 170th rail station project recently, much of which doesn't involve being on the track at all. And Gatwick Station that you saw earlier is a good example of that. But our rail business unit is our on-track capability, which is unrivaled. We have a whole series of, we have 18 in total, very heavy Colmar road rail piling rigs equipped with heavy piling masts, many of which we've innovated and developed ourselves with our specialist rig and mast builders. And we undertake a range of geotechnical services from track-mounted equipment that is unrivaled compared to anyone else. And that includes line-side piling, track bed piling, which is a stabilization technique, which is unique, by the way, in Europe. Anchors and nails to the side, sheet piling to the side, all sorts of things. And we do ground investigation as well off the track. And nobody does all of those things, and nobody does any of them individually to the level that we do. We have few competitors, but nonetheless they are worthy of being sort of careful of. Our biggest rival in this arena was Aspen, who went into administration in 2019, and they've been in trouble for a little while before then, and that left us as the clear market leaders. A couple of other competitors that we are wary of, or we work with occasionally. Keltbray have a rail piling team, but that's linked primarily to their vertically integrated electrification delivery in the rail sector. And we're on good terms with Keltbray. We rarely bid against them, apart from in electrification projects. But with the schemes that are ahead of us, we intend to potentially work together a little bit more closely. And then there are some smaller players who do smaller projects, and there are also some rail systems contractors like Volker and one or two others who like to do a bit of piling themselves in-house, but have a limited geotechnical experience. We are a geotechnical company through and through that works in the rail sector as well as others, rather than a rail contractor that's trying to do a bit of piling. And there is quite a difference. And then the only other competitors are plant hire companies who will claim to put a piling mast on a rig, but again, they're not geotechnical specialists. So that's the nub of things. Very quickly, where we are with our rail activity, the reason things have been subdued is because we've been going through a transition in Network Rail's control periods, their investment cycles from CP5 to CP6. CP6 for us has been slow in the first 2 years for the geotechnical work to come through. It's typically delivered through regional frameworks that are awarded to tier one contractors. Network Rail have reorganized their entire structure in that transition period. The tier one contractors have been re-procured, designs have been delayed, that work starting, we're starting to see those pipelines coming through. At the same time, electrification projects have been stopped in the UK after major cost overruns on the Great Western Main Line that you might have read about. But now we're at the point where we know that electrification is going to restart, and there are several projects in our pipeline that we are bidding in the next 2 or 3 months, starting next month. And so once we see both of those two dynamics returning, as well as what we've done to diversify our rail team in the period, and we increasingly put our rail rigs on smart motorways projects as well, because they're super powerful and very agile. We feel we've got the right ingredients for a more resilient performance going forward, FY22 onwards, than we've seen over the last 2 or 3 years.
Thank you, Mark. That's perfect. Graham, maybe I can just ask these 3 questions to you. Bill's asked, could you define what you mean by medium term when it comes to your financial targets? And is there a chance of the company paying a final dividend at the end of the current financial year? And if we could just couple that with a question when you anticipate reintroducing guidance to market?
Sure. I think take those in turn. The medium-term targets, we've gone through an internal process recently to revalidate those assumptions and those strategies to make sure that they are achievable. We've taken a look top-down at what we think will happen in each of the market sectors. We've taken a look bottom-up at what rig capacity and gang capacity we have to make sure that we can deliver to those levels. I think we've been deliberately vague, but the intention was sort of 3 to 5 years would be what we class as medium term. If the market comes back a little bit stronger, particularly in rail, and COVID gets we get past COVID more quickly, then we might be towards the front end of that. But if the current challenges endure for a bit longer, perhaps that might be towards the back end. The 3 to 5 years is sort of the range we were thinking. In terms of the dividend question, look, I think this year it's obviously a board discussion that will take place as we approach our year-end results. I can give you my view at the moment, which is that in this year we have, just as the introduction of the year, done a capital raise, and we've also taken advantage of the job retention scheme and claimed furlough monies of around about £2 million. So I think with that sort of backdrop, I think it would be optically challenging to pay a dividend in this current financial year. What we have said is that we'll revisit the dividend strategy, the dividend plans, once we get through the current period of disruption. So I think we want to get a little bit more certainty. That's probably the time we'll look to move on. In terms of reinstating guidance, the final point there, I think at the moment the only guidance that's out there in the market is with our house broker. That's currently sitting at, as Mark mentioned, we've just improved that slightly. It is still a loss for the year, 1.3 million, but I think that given the backdrop of the challenges we faced in Q1, the significant losses that we suffered, that's probably a reasonable target. If the market comes back with a bit more pace than we expect, then we'd like to think that's a reasonable target that we can hopefully do a little better than. In terms of reinstating formal guidance, I think it's very difficult in our sector at the moment with the level of uncertainty that we still see. We still haven't seen when the wider market conditions will stabilise. We still don't know a timescale for the lockdown ending. So I think it will be a judgment call on when we become confident enough looking forward in all of our divisions.
Okay, super. And if I could just follow up with one asset-based question for you, Graham. How much of your kit do you own outright? What is the lifespan, and over what period do you write it off in the accounts?
So we own all of the kit, although I should be clear on that and say that some has been purchased under hire purchase agreements. So the only debt that the group carries is 5.3 million at the end of the half year, which is the outstanding capital balance on mainly rig purchases, but some vehicles in there as well. It's not necessarily always the cheapest form of finance, so that's why one of the reasons that we have the RCF now in place. But effectively, the kit is ours as long as we continue to meet those hire purchase obligations. We'll continue to pay those down, as I mentioned, with the numbers I described earlier. In terms of the lifespan of the kit, we depreciate rig assets over 12 years. If they're very well maintained, they can last a little bit longer than that. If they're very hard work, they will be slightly less than that. But the 12 years is broadly, and we've got very different types of rigs, of course, so they do vary by type, but that's a reasonable benchmark anything else to mention? I think only to say that the group has invested heavily over the last 6 years. If you look at our annual report, you'll note that we mentioned that the business has invested 50 million in fixed assets over the last 6 years. So we've got a relatively modern fleet. It's well maintained. It's clearly a market leading fleet. And as at the period end, we have 115 rigs, and they range from very, very large general piling rigs right down to very small, £50,000 rigs at the smaller end, which are only used periodically.
So a fixed asset valuation, Graham,
yes,
is worthy of note, isn't it?
Yeah. So the net book value of our rigs is currently around 26 million. Obviously, a replacement value of those would be we estimate would be sort of 20 to 30% higher than that. But a very, very well invested, and as I say, modern fleet.
Super, thank you. Mark, I think just one more for you back in the rail sphere. How big could HS2 be, and is it more general piling than on rail?
Yeah, that's a good question. So HS2 geotechnical works, I'll take that to mean, is expected to add 20 to 30% more demand into the UK geotechnical space. Now, that won't all be met by UK contractors, unfortunately, because as some of you may know, there are multinational joint ventures active on High Speed 2, and nearly all of the tier ones have got in-house piling subsidiaries, whether they be French, British or Spanish. But it does create quite a significant resource drain potentially in that whole industry. So HS2 is very big, hundreds of millions of geotechnical work. For us, the work, you're 100% right. Initially, for the first couple of years, the work will primarily be big piling for bridges and structures, but also an awful lot of ground improvement work along the route of the track, and a lot of ancillary works of sheet piling and things. You can imagine interfaces and the like, and also importantly, perhaps slightly towards the back end of the phase one construction, the rail interface work, which is where we will have a strong position. But we expect to be active on almost every technique that is required. We're currently delivering works on High Speed 2 now, ground investigation, so right at the early start of things on the central section, and ground improvement, vibro stone columns on the southern section, and we're bidding a pipeline of 100 to 150 million of general piling schemes for different joint ventures in different places. And some will be put out to the market, some won't. We'll see. We're all very much in at the early stages of sort of feeling each other out. But yes, things are already starting to get busy.
Super, thank you. One question in and around growth opportunities. You have a strong balance sheet. Does this open up M&A opportunities?
Yes, it should. Our sorts of targets, though, will be very selective. We do consider things every now and again. We have clear areas where we would like to potentially target niche bolt-on capabilities if the right opportunities come along in our higher margin areas. So specialist piling and rail. We're not looking at transformative big acquisitions, and we're not looking at just regional bulking up either. We would very much want to play to the higher margin specialist areas if the opportunity comes along.
Great. Okay. Well, that's super. We're coming up to the hour, so I think that's been a comprehensive update. Thank you both for updating investors today. Could I ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback. If you are accessing this meeting from our website, the feedback page will appear. If you accessed it from the link sent to you by email, you'll be asked to log in to submit your feedback. If anyone has any further questions or would like additional information on Van Elle, please do get in contact via vanelle@walbrookpr.com. Alternatively, many thanks for attending today's presentation.